Good morning, traders. It is Wednesday, May 7th. We've got the Fed. We got Powell coming out at 2 o'clock today with the Fed speaking, and that will probably shake the markets up. We did see, if we take a look at the futures chart down here, the 10-minute chart, you can see after the close yesterday, Trump said there was a good meeting with Canada. It created a quick pop, and now it's kind of flagging sideways. So the markets are set to open slightly higher. They were up dramatically more, but fading back down, which is fine. Generally don't really want a big gap in price anyway. Gaps to the upside usually are in any direction on the S&P 500 typically get filled. So we'll let the market kind of fade its way back down, and we'll see how things unfold. I think we're going to hear things come out of the U.S.-Canada talk. We're going to hear what the Fed is going to do. Fed, I don't think, is really set to change rates. I think it's supposed to stay around 4.25 or 4.5. But we'll see. Everybody's got their eye on if the Fed is changing their opinions or their wording for the tariffs and Trump's changes or things like that. So expect wild moves in the market. And just a quick reminder, if you're watching this video and you're not subscribed, make sure you click the subscribe button right under the video, click the bell, and it just shows me that you like the content, and I do read your comments, and I try to weave in information that you guys want in future videos. So be sure to do that. Again, if you like the analysis, especially the short-term 30-minute chart where we've got panic selling and FOMO and short-term trends, you can always go to my website, thetechnicaltraders.com, and you can learn about our asset revesting strategy, also my shorter-term technical analysis, which is where the indicators I share are in the book. You're able to mimic those and the formulas to put into your charts and go from there. If we take a look at the overall equities market here, we take a look, we've got a series of kind of pops and moves. We're holding above this 5-day moving, or sorry, the 50-day and the 5-day moving average. We'll see if this gets traction and wants to continue to push and go higher. And I think the Fed today is going to definitely probably kick things into gear in terms of, is this market going to pop and rally, or is it going to start to have some more of a correction, potentially pull back, or have, again, a bigger, whoops, if I can get a pencil here, potentially flag out, maybe build a bull flag pattern before potentially having another push. I do believe we're going to want to see this market try to break this high. This high will definitely squeeze the shorts out of the market. Eventually we'd have a new type of Fibonacci extension target that brings us up to here, which we've talked about. So we'll see if the market wants to do that. I think today could be a fairly big turning point in the market in terms of price action with the Fed and some direction for investors. Now, if we take a look at the weekly chart of the S&P 500, we had a bear market signal happen back over here. And of course, you go into a bounce. And what's interesting here is we ended up breaking this nominal high right here. The market loves to go up and pierce these previous highs. So the market had a big crack to the downside, had a bounce up, came back down, and then it came up. And what it does is when it breaks this pivot high, anybody who's short and betting on falling pricing, this is where they get squeezed out. It's called a short squeeze. It's running of the stops. The shorts will have a stop, meaning if it gets above this price, they have to buy back and cover it because it means the market's going higher, or so they think. And then, of course, right when they get out of the play, the market collapses and the shorts missed out on the move. So I believe we're in something very similar. We have a bear market signal in the market here. I believe we're going to see this market eventually want to push up and break this pivot high right through here, create that short squeeze, and then from here it could roll over and we go into that bigger bear market phase. So obviously when we look at the longer term chart here of the S&P 500, we go from obviously a series of we've got rising tide, a bull market phase, we got a bear market phase. We just had a nice big bull market phase, and now we are in this bear market phase, pointing to, on average, lower pricing. But keep in mind, you do get some very strong, some of the strongest rallies in a bear market phase. Just like you get some of the strongest corrections and pullbacks in a bull market phase. So it's the opposite of what most people think. And you always hear these people talking about, well, if you don't hold through a bear market, you're going to miss some of the biggest rally days ever. Well, it doesn't really matter if something rallies 20% in a bear market phase, because it's just going to keep on going lower anyway. So there's this huge misconception of how people talk about the markets, and how if you miss out on the 20 biggest days, in the market, you've lost so much money. But it doesn't really work out that way. The biggest rally days tend to be in a bear market phase, and the price keeps going down. So anyways, looking at the markets, let's go back to the rest of the markets. What else is moving today? We do have bonds. They're trading relatively flat, trying to figure out what they're going to do. Obviously, everything around the Fed probably going to dramatically affect the price of bond. It does have a little bit of a bearish formation here. You could say it's channeling up in a big bear flag. We could use Fibonacci extension. We've got the high, we've got the low, we've got this high pointing to fairly dramatically lower pricing. This is bond futures, but on TLT it's about down to around 81. So we'll see how this plays out. Obviously, going to be very sensitive. Probably see some wild movement here. If rates, if no matter what happens, we're going to see probably bond prices fluctuate today with just the talk around rates. Taking a look at gold, we on our band strategy, we did get into a band trade, a gold trade right over here. You can actually see on our short-term analysis chart, you can see gold dipped into its oversold territory. It has run up, it hit our first target, closed out half of the position there. Now it is up at these highs, trying to figure out what to do. Overall, we had this short-term bearish formation. This came right down to the 618. If I was to just draw this in here real quick, you can see the short-term price action based on this pattern is right here. So it came down to the 618. It found support there, and it's reversed around. And now it's testing these highs and wanting to see if it wants to go higher. So we'll see if this continues to leg up. Again, we don't want to bet against a gold. It is in a very strong market. But now we have this new potential bull flag formation forming that does point to higher pricing. Obviously, you can see here, based on this new chart pattern, we got the rally up. We got the bull flag, this nice little three-wave correction, this A, B, C. The C wave that breaks this pivot low creates a flush out. People get out of it, they panic, and then of course the market shoots up. And so it has potential now to run to 3,750 if this pattern plays out. Now right now it's still kind of in this kind of phase right here, but again, gold in a very strong uptrend. We're not picking, you don't want to pick a top in this. I am overall longer term bearish. People need to understand the different time frames. I think this is where I confuse most people. I see it in the comments all the time, which is, you just said last week you're bearish on gold, and I am bearish on gold on the monthly chart. I do believe we're going to be trading much lower, 6-8 months from now. Short term wise, it is in a raging bull market. And every pause and pullback and reversal gives us a new upward target to map out where it could go. It is in a bubble phase. It could keep going. And I keep seeing people betting against it. And I can't help those who don't listen to the analysis. You have to try to decipher between the long-term chart. We are in this kind of buying, I think, in this area is a higher risk play. I do think it is in an uptrend. But I do think, 6-8 months from now, it is going to be trading dramatically lower. But short-term wise, if you're a short-term trader, this is still just a bunch of series of rallies and pauses. And that's what you need to decipher is what type of trader you are. Some people listen to the long-term analysis and then they trade short-term on it, or they hear the short-term analysis and they change their long-term positions on gold. They're completely flipped. They always tune into the most extreme scenario and you don't give regard to what analysis or what style of investing you're looking at. So you have to try to break that. I try to always show the markets from a long-term perspective. I always show, even for gold and everything else, but I show, are we in a bull or bear market phase? And then we zoom into the daily chart for analysis. And then I go into the 30 minutes. So I'm showing you the 34,000 foot view, like you're in a jet air looking down. I give you the daily chart, which are the overall swells and waves in the ocean that we like to trade. And then we focus on the short-term noise of panic and FOMO so that you can feel the energy in the market of what people are doing, and we can see what they're doing with their money. And when you have all three of those together, you really get comfortable in the market. But if you can't decipher and understand all those, then that's okay. But just focus on when I'm talking on a daily chart, just focus on the daily chart analysis. Don't get caught up in the noise of the shorter term stuff. Don't look at the long-term trends. Just focus on the strategy that you're focusing on. If you're a swing trader, then you probably want to just focus on the daily chart, trading our swing and position trading with the ACS strategy. And don't get caught up on this noise or the super long trends that will sometimes go against our daily chart analysis. So gold is pulling back a little bit today after a huge pop yesterday. Silver's pulling back a little bit as well. Again, silver's popped up into a short-term resistance. Also, trying to figure out what it wants to do. The market does look like gold, silver, and miners want to push higher. If we look at gold miners like GDX, which I think is the best barometer, you can see it's very similar to gold. It's rallied up, it's pulled back, and it's starting to push higher. Again, the precious metal space is in this this phase where it should continue to act as a defensive play and want to move higher. If we take a look at URA, the uranium space, there was some big news there yesterday that was really starting to move the markets. We are long URA with our band strategy. It looks like we are set to open at our target this morning to sell off half the position, lock in some more profits on this as well. So overall, the market is the markets are slowly coming around. We're starting to see some life in these random sectors and these pockets as this market kind of gyrates. Again, a lot's going to happen today with the Fed. So again, we just take it one bar at a time, play the trends and the analysis, focus on the sectors and the assets that money's flowing into, and go from there. If we take a look at natural gas, I haven't looked at this in a while. A few of you wanted me to touch it. So if I just take a look at it, I think the key here, I'm not a big natural gas fan, but it has had a very strong move to the upside. It's had multiple surges to a high, a whole bunch of them. It has kind of cracked to the downside. It broke these lows. It's broken more or less these lows here, and now it's kind of reacting up into this high, which to me feels like it would eventually roll over and fizzle out. And if we zoom out on the chart, we've seen this kind of happen before, where it puts in a big move and then it has this crack to the downside here and this bear market rally or this kind of like bounce up, and then it goes even lower. And so I believe we've had that crack to the downside, and now it's in this bounce phase. Maybe it wants to push a little bit deeper into all of these highs right through here, but overall it feels like the momentum has gone from up to now it's down. It's just a matter of where does it find a high, right here and roll over, or probably over here and roll over. And again, if we look back on the charts even more, you can see the same type of thing. Big move up, big volatility, these surges to highs, a crack to the downside, has a bear market bounce, and then, or rally, dead cat bounce, whatever you want to call it, and then it sells off and goes lower. So that's kind of where I think the market is kind of headed at this point. If we take a look over at crude, not a whole lot has changed. It's up about 0.5%. It's having a little bit of a bounce after hitting this wick low where massive volume came in after the breakdown through the $65 per barrel level. So it's having a technical bounce at this point. Again, I'm pretty bearish on the economy. My opinion is bearish. My kind of analysis is bearish. This is just a bounce. I think oil is going to continue to go a whole lot lower, like $44, $45, maybe $46 a barrel to the downside, because I think things are about to come to a grinding halt. Now, the tariff stuff obviously going to probably create a huge pop and spike if there are reduced tariffs and all that stuff. I think they'll be short-lived, but expect lots of volatility. And overall, my bias is to the downside. That being said, guys, I don't trade on my bias. I trade the charts. That is the key. No matter how bearish I am, we still end up getting long and we ride the markets higher. Like last year, I've been bearish from the markets for quite a while, but we don't trade what I think or feel. We trade what we see and where the opportunities are, and we trade statistics. We trade and manage risk. And it has nothing to do with the news, nothing to do with our emotions or what we think or feel is going to happen. I think last but not least, I think one sector that's kind of coming to life a little bit here is XLU. It is popping and starting to break out. Let me just zoom out a little bit more. It's been holding up very, very well. And generally when XLU dramatically outperforms the S&P 500, we tend to see a bigger market correction coming. It doesn't mean it's going to happen right away, but it is usually, within several weeks, a couple weeks to a month, we usually see that happen. So it's going to be interesting to see how this plays out. If utility stocks continue to drive higher, then that to me is a big warning sign the stock market is more so in a bear market rally, and it's going to get closer and closer to a top. And then when the stock market does roll over, utilities will roll over with it. Pretty much everything gets sucked down with the stock market when fear hits. We've seen that in gold. We had the big bout in selling. Like if we, for example, just go to the S&P 500 and we look at this like 4-day sell-off. This was the first 4-day sell-off where we saw a huge panic in the stock market. We haven't seen panic and fear like that in a long time. I've shared this chart. Those 5 days going down is where things ramped up and everybody flipped from being bullish and trying to pick a bottom, the bottom pickers, to realizing that wasn't the bottom. And then they start looking to bet on falling pricing, buying inverse exchange traded funds. And so this type of fear is what happens in a bear market for months and months and months. In some cases, years, like the tech bubble took 3 years to unfold. And when we have this type of fear hitting the market, pretty much everything goes down. If we take a look at utilities real quick, utilities, huge crash. If we take a look at dividend stocks fell extremely hard, 14% in 4 or 5 days there. Dividend stocks have no protection. Take a look over at gold. Gold, which is seen as a safe haven play, it held up much better than everything else. But for gold, this is a big drop in gold, a 7% drop in gold in that window. So everything gets hit, and that is the most important thing to understand is when the market starts to head down, we enter a bear market phase or stage 4 decline, a financial reset. There is no real protection. You have to move to cash and preserve your capital and just earn interest and be happy with that, or play inverse ETFs and profit from the drop and bet with the falling market, which is what we do. We do both of those depending on the market scenario. Anyway, I think that's it for now. We'll see how the day shakes out. Expect volatility. I'm probably expecting to see some FOMO indicator or panic selling indicator spike up today in the stock market with the Fed at 2 o'clock p.m. Eastern time, and we'll go from there. Take care. Bye-bye.